Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Krispy Kreme.
If you find our talks useful, please consider subscribe, like, and comment underneath. And seeing as it's Friday, February 27th, 2026, it really does feel like the perfect day to talk about a treat.
It absolutely does. But, the investors looking at the stock today, they aren't just looking for a morning snack. They're looking for a complete structural turnaround.
They certainly are. And judging by the market reaction this morning, they might have actually gotten exactly what they wanted. I mean, we were seeing some really serious movement on the charts.
We certainly are. The headline here is just, well, it's unavoidable. They reported their Q4 2025 earnings, and the stock immediately surged 20%.
20%. Which is, that is a massive move for a food company.
It's huge. Usually, you see that kind of volatility in tech or maybe a biotech stock waiting on some FDA approval. But for a donut chain, that feels incredibly aggressive.
So let's unpack this. Did they sell a record number of donuts? Did they discover some zero-calorie glaze? What exactly caused this explosion?
Well, here is where it gets fascinating. And honestly, it's a little counterintuitive at first glance. If you just look at the top line numbers, revenue is actually down.
Wait, really? The stock is up 20%, but they made less money than last year.
Correct. So Q4 net revenue came in at $392.4 million, and that is down 2.9% year over year.
Okay, I'm slightly confused. Because usually Wall Street heavily punishes shrinking revenue. I mean, the old saying is, if you aren't growing, you're dying. Why are investors celebrating a contraction?
Because this wasn't about raw volume. It was about turnaround validation.
Right.
They beat analyst estimates slightly, sure, by about 0.9%. But the real story here is about the quality of that revenue. It is a classic case of efficiency over ego.
Efficiency over ego. I like that.
Yeah. For a long time, this company was just obsessed with being everywhere at once. Now they are finally prioritizing profitability over their physical footprint.
So it's kind of like less sugar, more protein.
In a financial sense, yes, exactly. The market is cheering because the management team is proving they can actually make real money, not just blindly move product.
Okay, hold on. I want to really dig into that strategy because, efficiency is very often just a polite corporate word for
we're in trouble.
Exactly. We're in trouble, so we're shrinking. If revenue is down, that usually means they are actively selling less stuff or closing stores. Is that what's actually happening here?
It is, but you really have to understand the specific model they operate to see why it's actually a very good thing. They are calling the strategy door rationalization.
Door rationalization. That definitely sounds like a euphemism for closing up shop.
It effectively is, but it's highly surgical. They are exiting specific doors or points of access that were just bleeding money. To really grasp this, you have to picture their hub-and-spoke model.
Right, I've definitely heard this term thrown around. Break it down for us.
Okay, so unlike a Dunkin or a Starbucks where every single store bakes or brews its own product on-site, they have hubs. These are the massive factory stores with the big conveyor belts and the glazers.
The ones with the hot light?
Exactly. They make the donuts there in bulk, and then they physically truck them out to their spokes.
And spokes would be things like grocery stores, gas stations, bodegas.
Yes. Now, imagine a scenario where a truck driver has to drive 35 minutes out of the way to deliver fresh donuts to one specific gas station.
Okay.
The gas for the truck, that driver's hourly wage, the wear and tear on the vehicle, all of that costs money.
Right. Logistics are expensive.
Very. And if that particular gas station only sells, say, 10 boxes of donuts a day, the cost of the actual logistics is much higher than the profit from those 10 boxes. You are literally paying money to sell your own product.
So by servicing that one location, they were actively losing money on every single donut sold.
That is the textbook definition of empty calories in business.
Yeah.
So door rationalization is them finally looking at the map and saying, cut that route, cut that store. It is simply not worth the gas.
Okay, that makes perfect sense when you frame it like that. It is addition by subtraction. So what does the actual damage look like? How much did they cut?
If you look at the U.S. segment specifically, revenue fell 6.1%, down to $230.2 million. And the company was very transparent about it. That drop was explicitly because they closed those underperforming spots.
How many spots are we talking about?
Globally, they went from over 17,000 points of access down to 15,194.
Wow. Okay, that is not a small trim. That is a massive reduction in their physical presence.
It is, but, and this is the real aha moment of the report, you have to look at the key metric they use, which is average revenue per door, the APD.
Right. How much cash each remaining individual spot is actually generating.
Exactly. That number actually rose 4.5% to $660 per week.
I see. So even though they have significantly fewer locations out there, the ones they kept are highly productive.
It signals that the underlying demand in their core locations is actually very strong. They weren't suffering from a lack of customers wanting donuts, they were suffering from logistical bloat. By closing the weak spokes, the average health of the entire network just shoots up.
It's basically like pruning a tree. You have to cut the dead branches so the rest of the tree gets the nutrients it needs to grow.
That is the perfect analogy.
But let's play devil's advocate here for a second. Revenue per door is a very nice metric for a corporate spreadsheet. But does it actually pay the bills?
Yeah.
Because you still have corporate overhead, you still have massive debt. Does this new efficiency actually translate to the bottom line?
That brings us directly to the wealth-building angle of today's analysis. And this is genuinely where the bulls are getting so excited. We need to talk about their margins and their EBITDA.
Everyone's favorite financial acronym. Earnings before interest, taxes, depreciation, and amortization.
It is the gold standard for measuring raw operating performance. Adjusted EBITDA grew 21% to $55.6 million in the quarter.
21% growth. That is significantly higher than the revenue beat. In fact, it is the exact opposite direction of the overall revenue decline.
Which tells you that their profit margins are expanding rapidly. In fact, margins are up 280 basis points year over year, and they are now sitting at 14.2%.
Okay, for the listeners tuning in who don't spend their entire day staring at Bloomberg terminals, let's contextualize 280 basis points.
Right, of course. A basis point is simply 0.01%. So 280 basis points is 2.8%. Now, in the software world, a 2.8% margin bump might not sound like front-page news.
Software has huge margins anyway.
Exactly. But in the physical food and retail business, that is massive. These businesses usually fight tooth and nail for a 0.5% improvement. Jumping nearly 3% in operating margin in a single year is literally the difference between barely breaking even and making a very serious profit.
So for every single donut they sell now, they're keeping a much, much bigger slice of the profit.
Yes. That margin expansion comes directly from these productivity initiatives, significant savings on SG&A, that's selling, general, and administrative expenses, and frankly, just management operating a much tighter ship.
Okay, but I know how you analyze stocks. You always say EBITDA can be a little fuzzy, it can hide certain corporate realities. You usually prefer cold, hard cash.
EBITDA is an opinion, cash is a fact. You cannot pay off your corporate debt with adjusted EBITDA. You need actual cash in the bank. And this is the most critical wealth indicator in this entire earnings report. We absolutely have to look at free cash flow.
The holy grail of financial metrics. So did all this pruning actually put real cash in the bank account?
It did. In Q4, free cash flow surged to a positive $27.9 million.
Okay, roughly $28 million. Is that a good number relative to where they were previously?
It is a night and day difference. You have to compare it to the exact same quarter the previous year. Last year, their Q4 free cash flow was negative $6.9 million.
Wow. So they swung from actively burning cash, literally setting money on fire just to keep operations going, to generating nearly $30 million in pure surplus.
That is the pivotal moment for this company. And if you zoom out and look at the second half of 2025 as a whole, free cash flow was $43.5 million. This represents a fundamental shift in the entire risk profile of the stock.
Why is that specific swing so important right now? I mean, obviously having cash is always good, but why does it matter so much in this current environment?
Because of the debt load. You really have to remember that this company has been carrying a very heavy burden of debt. When you are cash flow negative, you literally have to borrow more money just to keep the lights on or to open your new stores.
Which just adds compounding risk, especially when interest rates are as high as they've been recently. You're just digging a deeper hole.
Right. It is exactly like using one high-interest credit card to pay off another credit card.
A terrible cycle to be in.
Precisely. But the moment you flip to positive free cash flow, suddenly you are self-funding. You can finally start paying down that debt, a process they call deleveraging, and you can fund your future expansion without ever having to ask the bank for another loan. It puts the company entirely in control of its own destiny.
That is a huge structural moment. It basically changes them from a distressed turnaround story to a sustainable growth story.
And that transition is exactly why you see a 20% surge in the stock price today. The market is aggressively pricing in that new safety.
So we've got a much tighter ship, we have much better margins, and they have actual cash piling up in the bank. But let's shift gears and talk about the actual product for a second, because you can't just spreadsheet your way to infinite growth forever. Eventually, a real human being has to actually want to buy and eat the donut. What is realistically protecting them from the competition? Because Dunkin's on every corner, the local boutique bakery is down the street. What is their actual moat?
It is a great question because in the food business, true economic moats are incredibly hard to come by. Anyone can fry some dough and put sugar on it, but they have something entirely unique: the hot light.
Oh man, the hot light. I have to admit, when that neon sign turns on, it triggers a genuine biological response in me.
It really does for millions of people, and that is their proprietary fresh donut production process. It isn't just baking, it's theater. It is an interactive experience. You simply cannot get that from a donut that was baked in a giant factory 3 days ago, flash frozen, shipped across the country, and thawed out on a rack.
It's completely true. A warm original glazed right off the line is practically a completely different food group than a cold donut sitting in a display case.
And the financial numbers absolutely back that up. Remember that average revenue per door growth we talked about, that 4.5% increase? That fundamentally proves they possess real pricing power. People are clearly willing to pay a premium for that specific experience, but there is actually another layer to their moat that is quietly growing very fast, and that's digital.
Digital donuts. You can't exactly download a glazed donut.
No, but you can download the order. Digital sales now make up 18.2% of their total retail sales.
Nearly 20%.
Yeah.
That is actually incredibly impressive. I usually think of this brand strictly as an impulse buy. You are driving by, you see the red light, and you just stomp on the brakes.
It historically used to be just that, but now it is rapidly becoming a planned purchase. People are actively ordering ahead for weekend parties, for the morning office meeting, for local delivery. That sticky digital ecosystem makes their daily revenue far more predictable. Plus, it allows them to gather invaluable data on their most loyal customers, which helps them market much more efficiently.
And I imagine that predictability really helps with the logistics side too. If you know exactly how many corporate orders are coming in 24 hours in advance, you know precisely how much to bake.
Exactly. It drastically reduces food waste, which again flows straight down to help those expanding margins.
Now, I wanted to circle back to something you mentioned earlier about their capital light expansion plan. You said they aren't opening as many of their own physical stores anymore. How do they actually achieve top-line growth if they aren't built new buildings?
This is the third critical pillar of the turnaround strategy: international franchising.
Right, getting other people to build the stores for you.
Think of it this way. If they want to rapidly open 50 new stores in an emerging market, say Brazil or Turkey, they essentially have two choices. Option A is they spend $20 million of their own corporate cash. They try to hire local managers. They have to navigate complex foreign labor laws, and they just hope it works out.
And if it fails, they lose the entire $20 million. High risk, high reward.
Exactly. But option B is they find an established local partner who already knows the exact market dynamics. That local partner puts up the $20 million. The partner handles the real estate and hires the staff. The partner takes on all the local financial risk. The corporate entity just provides the iconic brand, the secret recipes, and the operational system, and then they just sit back and take a steady royalty percentage on every single sale.
So it is effectively an infinite return on invested capital because they aren't actually using any of their own capital to generate that new revenue.
You nailed it. They are pivoting extremely hard to option B. It allows them to grow the brand globally at a very fast pace without weighing down their own fragile balance sheet.
And this ties perfectly back to that free cash flow metric we celebrated earlier. They aren't draining their new bank account surplus to construct new buildings in foreign countries.
Correct. It all connects beautifully into one cohesive strategy. This is exactly why the market is so excited today. It is fundamentally a safer, smarter way to scale a business.
Okay, I am definitely feeling the sugar rush here. It all sounds pretty amazing. The stock is up, cash is finally flowing, the hot light is on. But I do have to do my job here. I have to be the skeptic for our listeners.
Please do. We need the full picture.
It cannot possibly be all sprinkles and glaze. There has to be a bear case here somewhere. What are the bulls actively ignoring today?
You are absolutely right to ask that. And if we strip away the adjustments and look purely at the GAAP numbers, the generally accepted accounting principles, it is really not a pretty picture at all.
Okay. What is the actual damage?
Despite all that adjusted EBITDA we just celebrated, the company still posted a hard GAAP net loss of $29.1 million in Q4 alone.
Ouch. And what about for the full year?
For the full fiscal year 2025, they posted a massive net loss of $523.8 million.
Over $500 million. That is a truly staggering amount of money to lose making donuts.
It is a very hard number to look at. Now, there is crucial context there. A significant portion of that comes directly from restructuring charges, about $39.8 million worth in Q4 alone. That is the actual painful cash cost of closing those underperforming stores, breaking long-term commercial leases, and paying out severance contracts.
So that is the literal bill they received for pruning the tree.
Yes. And then there is also the ongoing interest expense. They paid $65.8 million annually just in interest payments on their existing debt. That is a very heavy anchor to drag around while you are trying to sprint.
That is real cash leaving the building every month. So while the adjusted numbers look fantastic because management gets to legally ignore some of that one-time stuff, the actual corporate bank account took a very serious hit this year.
It did. And that leads directly to the second major risk for investors, the shrinking risk.
What exactly do you mean by that?
Well, we just spent the first half of this show praising them for aggressively closing stores to increase their operational efficiency. But there is a mathematical limit to that specific game. You can only close so many locations before you simply cease to exist as a major global brand. Revenue contraction is a very real threat. Being down 2.9% is perfectly fine for a short turnaround phase, but if that trend continues for 2 or 3 consecutive years, you aren't turning around anymore, you're just liquidating.
Right. You cannot shrink your way to greatness forever. At some point, you have to actually start growing the top line again.
Precisely. If that average revenue per door metric ever stops growing and they don't have a pipeline of new profitable stores opening, they are just going to be a smaller company making less money overall. The entire market today is essentially betting that this shrinking phase is temporary. But if it accidentally becomes the long-term trend, that 20% gain in the stock price we saw today will vanish very, very quickly.
So the pressure is entirely on management now. They've successfully cleared the deck, but now they have to actually sail the ship forward.
That is the perfect metaphor for where they are today.
So looking ahead then, what does the captain or the management team say about the destination? What is the official guidance for 2026?
They are definitely signaling a shift back to controlled growth. Management explicitly stated they expect system-wide sales growth of 2 to 4% in constant currency for fiscal 2026.
2 to 4%. That is fairly modest, but importantly, it is positive.
It is. And remember that growth is coming off a very large base of $1.96 billion in 2025. So they are effectively telling Wall Street the strategic shrinking phase is over. We are starting to build again.
And what should you, as an investor listening to this, be actively watching over the next few months? What are the upcoming catalysts that could move the stock?
The very next earnings report will hit around May 2026. We absolutely need to see if that revenue decline actually stabilizes and flips positive like they promised. But beyond the standard earnings, keep a very close eye on refranchising updates.
Specifically in Japan, right? I saw that briefly mentioned in the preliminary notes.
Yes, there have been very persistent rumors and active executive discussions about refranchising their entire Japan operation. If they can successfully pull that off, meaning they sell those corporate-owned stores to a large franchise partner, it would bring in a massive chunk of immediate upfront cash and further improve that overall margin profile. It would be another huge validation of their capital-light strategy.
And what about macroeconomically? We are sitting here in early 2026, investors are clearly rotating their capital. How does this specific stock fit into the much bigger market picture?
We are seeing a very clear rotation in the broader market right now. Investors are actively looking for beaten-down names that are finally turning a corner. The big tech trade has gotten extremely crowded and expensive. Consumer discretionary stocks have had a very rough couple of years, but companies in that sector that are proving they can fix their own internal problems are attracting a lot of fresh institutional attention. This is a classic recovery play.
So let's wrap this up and bring it all together. We have extensively covered the massive surge today, the door rationalization strategy, the incredible flip to positive cash flow, and the reality check of a $500 million gap loss. It is time for the final verdict. How are you personally scoring this stock right now?
Taking everything into careful account, The clear execution on the turnaround, the vital shift to positive free cash flow, and a very coherent strategy moving forward, I am giving this a bullish score of 8 out of 10.
An 8 out of 10. That is a pretty high conviction score given the massive net loss they just posted.
It is, but you have to remember that the stock market is a forward-looking mechanism. It looks forward, not backward. The 20% surge today is justified because the turnaround is actually working. They are effectively trading their old philosophy of growth at any cost for a new philosophy of profitable growth, and that is a trade that long-term investors absolutely love.
So how would you advise playing it strategically?
I see this setting up perfectly as a classic swing trade based on the current momentum. The breakout today is incredibly strong. You can ride that wave. But importantly, it has the real potential to extend into a multi-year long-term hold if and only if they execute that international refranchising well, and they actually hit that 2026 top-line growth guidance.
So buy the momentum, keep the receipt, and watch the next quarterly report very closely.
That is exactly the play.
You know, it really reminds me of something incredibly fundamental about business in general. There is a huge fundamental difference between a company growing its footprint, just taking up physical space in the world, and a company actually growing its wallet.
That is a brilliant way to frame it.
Because for a very long time, this company was just obsessed with the footprint. The mentality was, let's be everywhere on every shelf. Now they're finally fully focused on the wallet. The new mentality is, let's actually keep the money we make. It is a much harder financial discipline to master, but it is ultimately the only one that builds real generational wealth in the long run.
You are absolutely right. And for you, the listener, that is exactly the question you need to be asking about your own portfolio holdings tonight. Are the companies you own growing just to get bigger, or are they truly growing to get richer? Because as we saw today, there is a massive difference.
A very expensive difference if you happen to get it wrong.
Indeed.
All right, that is a wrap on our Krispy Kreme analysis for today. Go check your portfolios. Maybe treat yourself to a donut. Just one, though. We are all watching our figures here, and we will catch you in the next one.
Thanks for listening, everyone.
Stay smart.